Hello guys, so today I want us to talk about the accounting cycle. Now you have a transaction, that's number one. From the transaction you identify source documents, that's number two. Now let's talk briefly about the transaction. A transaction is actually an economic event. So where there's a where there is an event, whether it's a transfer of assets and liabilities, or it's um, it's a yes transfer of asset or liability, or someone is buying, someone is selling, someone is entering into a contract. So a liability takes place or arises, then that's your transaction, right? Now let's talk about the source documents. So it means that there needs to be a transaction. Now from the transaction you need to identify the source documents, like I've already indicated. If someone is buying, you need to check how are they buying. Are they buying for cash or are they buying on credit? If they're buying on credit, you will have a source document known as an invoice, right? If they are buying for cash, you will either have a receipt if they are buying for with hard cash. If they are buying through EFT, you'll have a bank statement, right? If they are buying through a check, you'll have a check counterfoil, right? So the check counterfoil is actually the duplicate of the original checkbook. I mean, of the original check. After it has been signed, all the after the check has been filled and signed, right? So it will have everything, but it's just a duplicate, right? Now that's a check payment. Now you also have the other source document. You'll have what we call a credit note, right? So a credit note is a document that's issue that the supplier issues to the buyer to acknowledge the return of goods. So if a buyer buys something and then they later on return that item or items due to whatever reasons. There are various reasons. Some of those reasons could be maybe the item is damaged, or the item is incorrect size, incorrect quantity, incorrect quality, maybe inferior quality, or the item has just been damaged or obsolete, it's expired, right? Now they can return that item. So when they return, they will get what we call a credit note to acknowledge the receipt of those items. Now, if it's a business to business transaction, you will also have a debit note. So the business that has bought items, so the business that returns items, which is the customer in this case, will issue a debit note to the seller to say, I am returning these items, um, the number of items, the description will be there, the amount and the total amount payable will be there, right? Now, it is to say, I have returned these items to you. Now, the supplier will also issue the credit note to the buyer. So you have both the debit note from the buyer to the seller and the credit note from the seller to the buyer, right? Now, what you can also have. Okay, now let's talk about these source documents briefly. Let's talk about the invoice firstly. Now, between the invoice, in fact, all the source documents, you need to understand, you need to check whether the source document is original or a duplicate. So by a duplicate, I mean a copy, right? Now, if it's an original, you need to check, is it received or it has been issued. Let's talk about an invoice, for example. If we as a business have received an invoice, so you check it's an original invoice. It means we have bought items on credit, so we owe somebody. Now, the journal that we need to prepare, it's a purchases journal. So purchases journal is also called creditors journal. Now we need to prepare a purchases journal, right? So if we have an invoice, but the invoice is a duplicate invoice. It means we have sold something on credit. Then we have given the data an original invoice, and we remained with the duplicate invoice. So now what do? You need to prepare a sales journal, or what we also know as a debtors journal, right? So you prepare a debtors journal because we've sold items on credit. Now, if you have an original credit note, it means that we have returned items and we have received that credit note. So you prepare a purchases returns journal, or we also call it creditors allowance journal. Now, if we have a duplicate credit note, it means that a debtor or a customer has returned items to us. So it means that we need to prepare a sales returns journal, or we also call it debtors allowance journal, right? Now, let's talk about a situation where we have a receipt. If we have a receipt, it means that we have received a payment, so it's a cash receipt journal. If we have a deposit slip, it means we have received money, then we prepare a cash receipt journal. If we have okay, now a deposit slip, you need to check the deposit slip. Is it an original deposit slip or it's a copy? If it's an original, it means we have deposited money into someone's bank account, so we have an original, then it's a cash payment journal. But if it's a duplicate, then it means that we have received money from someone, therefore it's a cash receipt journal. Now, if it's a check, if we have received an original check, then it's a cash receipt journal. We received the money. But if it's a duplicate check, or it's a check counterfoil, it means that we have issued check to pay somebody, and therefore it's a payment, so we prepare a cash payments journal. If we received EFT, so in the bank statement there is an EFT received by us, then it means that we need to prepare a cash receipt journal. We received money. But if it's an EFT to somebody else, then it means it's a cash payment journal. So sometimes it's not EFT, it's a debit order or stop order. It means we're paying someone, and therefore it's a cash payments journal, right? Now, I think we have covered the most parts of the source documents. Now let's talk about the very last one. So that one is a petty cash. We also have a petty cash journal. So firstly, let me summarize the ones that I've spoken about. We have purchases journal or creditors journal. Then we have a sales journal or debtors journal. Then we have a cash payments journal and cash receipt journal. Then we also have purchases returns journal and sales returns journal, right? Or creditors allowance journal or debtors allowance journal, right? Now we add the petty cash journal. So what is a petty cash journal? Now let's talk about the petty cash. Petty cash is money that the business keeps. It's normally a small amount just to buy petty items. Yeah. For example, some businesses may keep 500 rands just to buy stationery, or maybe to fix certain things that have broken in the business, right? So they keep that money. So it depends now, how do they keep it? Some businesses keep it in cash, and some businesses actually buy a voucher and then they keep that voucher, a petty cash voucher. They create a voucher and then they keep the petty cash voucher. So instead of buying with cash, they buy with a voucher. Now, how do you account? So in a petty cash journal, whenever we purchase something using, so it's more like a cash payments journal, but the difference is that we are paying using the petty cash. You are paying for the items, but now you are using petty cash. Now let's say you use petty cash to buy stationery. So we need to prepare a petty cash journal because we have a petty cash, we have used the petty cash to buy something. And sometimes when you take the money out of the business bank account, then you keep it as petty cash. You also prepare a petty cash journal. It increases because the money has been increased into the petty cash account, or the petty cash into the petty cash account. Now you need to increase the balance in your petty cash journal, right? So let's talk about the last one now. So this one is not always related to a transaction. So sometimes it's associated with adjustments in the business. For example, when the business estimates depreciation, so there is no cash involved, there is no credit involved, then it means none of the journals that I've spoken about will be affected, but it still needs to be recorded in the books. And before it goes to the ledger, it needs to be in the journals. So which journal does it go to? So whenever there is a depreciation, you don't record it in the aforementioned journals. You record it in the general journal, right? Using the debit and credit of the general journal. So the difference between the other journals and the general journal is that the general journal records everything, including adjustments, whereas the other journals record only selling and buying, right? Selling and buying, and liabilities. Yeah. Now, the other difference in the general journal is that it has a debit and a credit. So you apply the double entry principle. So it's more like the general ledger. You apply the double entry principle, right? Now, I think we've covered almost everything in the journals. Let's talk about the ledger.